Welcome to the Stock Spinoff Investing Podcast. This podcast is for informational purposes only, and I, Rich Howe, and the people I interview may own securities that we discuss during this episode. Please consult with an investment advisor before buying any securities mentioned on this podcast. Hello, everybody, and welcome to the Stock Spinoff Investing Podcast. Today, I'm delighted to have David Bastian of Kingdom Capital joining me. We're going to be talking all things spinoffs. And I thought it would be great to start with, David, first of all, just your background, just how you kind of the founding story of Kingdom Capital. And then we can jump into some other stuff. But would love to hear a little bit about your background and how you ended up starting Kingdom Capital.
Absolutely. Thanks for having me on, Rich. So Kingdom Capital, we're getting really close to 3 years in operation now. So launched beginning of 2022. Kingdom Capital, as it currently stands, is me and one other guy, Michael Cooper. We launched it together. We got to a good point in our careers where we were ready to go out on our own. We had actually, our first thing that we tried before we launched to see if we could work together was buying and renovating a rental house, and figuring out that if we could do that together and not hate each other at the end of it, that we'd probably be able to work together in a more full-time fashion. So, Mike and I both had a lot of interest in the investing space, had both worked in various forms on financial matters in our careers. I worked in mergers and acquisitions consulting prior to this, in my generally helping private equity clients buy and sell businesses. Seeing how much money they were making on those and just getting an understanding for how some of those great private equity minds think about creating value helped me to kind of take those concepts and apply them to the market and generate good enough returns that I was able to get some interested investors and give myself some runway to go out and make a go of this as Kingdom Capital.
That's great. And when did you start Kingdom Capital?
January of 2022.
January of 2022. Okay, great. And then before we get into spinoff related stuff, I was reading your bio and I saw that you play or played street hockey. So I was just wondering, do you still do that? And I want to learn more about that. Is that in a league or do you just play for fun with some friends, or how does that work?
The answer to both is yes. So it is fun with friends in the league. When I first moved down to DC, my roommate at the time informed me the first weekend we got here that we were signing up for a street hockey league. So it wasn't something that I had done previously. He had played in one back in Pittsburgh, and there was a league right down the street from our apartment that we signed up for. Unfortunately, the team let me stick around, even though I was basically starting at zero on my hockey skills. So it was a lot of fun, good to run around with the guys. I played with a few guys from work, some acquaintances, made a lot of friends in the league. So it's a fun way to get out there and get some exercise and play a little hockey. So
awesome.
One of my outlets when I'm not investing.
So I grew up playing hockey, ice hockey, and I played street hockey just for fun, just with the neighbors. But I didn't even really know that there were street hockey leagues. So I'm going to have to look into that. And then I have my son plays hockey. He's 6. So we might have to get some street hockey going in the summer when ice isn't really available. All right, pivoting to spinoffs. So talk to me about spinoffs. I know you're not exclusively focused on spinoffs, but I would say you're very active in the special situations world. So how do you typically invest or think about investing in spinoffs? And then we can talk about some specific ones.
Sure. So I think, as many people who have looked in the spinoffs world understand, there's opportunity for kind of an information arbitrage when you have a spin coming where you might have value getting unlocked in a way that it's really hard to screen for. Anything like that, plus coupling that with potential for forced selling or weird index dynamics. Basically, I like that there's a lot of moving parts and that there's opportunities for someone who's actually going to go in and look more at the fundamentals and kind of understand the dynamics of the transaction to get an edge relative to just running a screener and saying, hey, there's 10 spinoffs and here's how they're all going to perform. There's more nuance involved, and I think that gives the best opportunities for mispricing. So it's becoming a more favorite type of special situation for us.
Got it. And then I know one successful investment for you that I'd love to talk about, and I don't know if you still own it or not, or what your views are. I think you do, is an NLOP. So this was a spinoff from WP Carey. Basically, the
Yep.
spinoff, WP Carey spun off all of its office properties into a business, Net Lease Office Properties. And this happened last fall at the time. Not that the office market, everybody's so excited about the office market today, but at a time where there was kind of peak pessimism related to the office market. And I know that has been a big winner for you. So I'm curious, is that still a name that you still like? And I'd love for you to walk through how you thought about that opportunity and, why you were so excited about it and maybe are still excited about it if you still like it.
Absolutely. So yes, we definitely still like it. It's actually currently still the largest position in that fund. So we've been thrilled investors in net lease. Um, so it's funny. I think this investment actually showed a couple different ways that I've grown as an investor. One had been that about a year and a half ago, I kind of made a mental note to avoid the office space, and a reason for that being that I just felt like there were a lot of value-oriented guys that were going down that rabbit hole and saying, "Hey, these things are all selling off, therefore, there's deals to be had." Most of those guys ended up being right, but as I looked into a couple ideas there, I just realized I had very little opinion on the terminal value of office buildings and how that space was going to evolve over the coming years. And I felt like I was going to be making a bet on an outcome that I didn't have a strong view on, and that a lot of office things looked cheap, but there was also going to be a lot of carnage in the space, and I didn't feel comfortable trying to pin down where all that was going to land. So then along comes this spinoff, and as a dumpster diver in small cap special sits land, I had a lot of people sending me questions about it and asking if we were going to get involved and saying, hey, this is like the ultimate, garbage barge spinoff. And my initial thought was like, no, I said to myself, I'm not going to do office. And I kept looking at it and realized that, this actually, basically, I can go through this and get comfortable with this in a way that I didn't really think I was going to be able to with office at large, because I wasn't making a bet on long-term offices. I'm making a bet on the liquidation value of 59 buildings. And that's something that I got a lot more comfortable with. But while it was taking me time to get comfortable, the stock, dumped to $10 on the initial spin, and by the time I really was sure I was ready to get involved, it was back up at like 15 or 16, which is any good value investor who hates buying things after they've gotten off the bottom. That made it hard initially to want to buy a bunch, because you're thinking, oh, maybe it'll come back down, there could be more forced selling. But the value proposition was so compelling that, even averaging into the thing and continuing to buy it as after it got into the 20s and then started getting more visibility on asset sales. I think that's something I would have had a harder time doing earlier in my investing career, and that this opportunity really helped me see the benefits of averaging out and being willing to be flexible about stuff that previously I didn't want to get involved in.
So how do you think about the stock today? So stock, I think, is around $30, maybe $31. It bottomed as low as 10, it shot up pretty quickly. I think the company has realized some assets and hasn't paid any dividends, but this is essentially a liquidation. So they're going to pay out
Yep.
cash once they've paid out all their debt, or maybe they're going to even pay out some equity distributions, dividends before all the debt is paid off. But how are you thinking about the stock today at 30 or 31 or $32? What is it valued at on a cap rate basis? And then what do you think it's worth, I guess, is what I'm curious about.
Sure. So a couple things. They basically haven't had to pay dividends yet, given relative net losses they're realizing on some write-downs on real estate. They had to pay a small dividend at the end of last year. It ended up coming out as like a share-based dividend. So they just paid you a little more stock for each share you had. There's a cash pay option, but their debt is very restrictive about paying out cash dividends until it's paid off. So they've been limited in what they could do on that front so far. So yeah, no dividends. That is a non-starter for a lot of REIT investors. That was one reason that it can get a lot of love. As we look at it, I think one of the main reasons that people were afraid of these things is that they always take longer than you expect. And so there was a lot of fear that, hey, if I buy into this thing, how long is that going to take? Is it going to be 5 years? Is it going to be 10 years? And if you went through a lot of the WP Carey messaging around the spin, basically they were saying like, hey, we're actively liquidating this office portfolio. We're going to keep doing that, but it's cleaner for us to get it off our balance sheet. Frankly, it seemed like they just wanted people to stop bothering them about it. So they decided to just do this spin to essentially all they did was move the properties to a different entity. The same people who were working on the asset management team continued to work on it after the fact. The executive team that's signing off on the financials is the same as WP Carey parent company. They have a couple independent board directors, but other than that, like this entity has no real employees. It has nothing other than this basket of properties. So very little change for that. You know, the same guys that have been managing it continue to manage it. And frankly, the amount they're paying themselves to do it is so negligible in the picture of WP Carey that it doesn't create any incentive for them to drag this out. It's basically just an orderly as quickly as possible, get this thing sold, which they said was probably going to be in like the 3 to 4 year time horizon. So that got me comfortable, especially since the other main concern with that was they had very expensive debt that they spun this with. There's a mortgage loan and a mezzanine piece attached to that they got with JP Morgan, and the aggregate interest rate on that was about 12% a year, which, depending who you talk to, was either horribly punitive or they couldn't believe that they found somebody to lend on office. So I heard people on both ends of the spectrum, and it made me feel like all in, they probably did the best they could with how lending was working in that space about a year ago. So those are the dynamics, and I think just in terms of where this is going, there's about 40 properties left in the vehicle. They sold off a lot of good long leases, and they've almost finished paying off the debt. So, you know, I think we're going to start seeing kind of more of the liquidating dividends, as it were, here in the next few months. It's going to depend on some timing. There's plenty of assets in the pipeline to get sold. But we're at the point where there's quite a few of the properties where if we get a sale announcement tomorrow, the debt will be paid off and they can start doing dividends. So kind of just becomes a waiting game to see what comes out next.
Has most of the really expensive debt been paid off, or will that get paid off once the additional properties get sold?
Yeah. Most of the original expensive debt, it was $450 million about when the spin happened, and we're down to less than $100 million net. There's $48 million of restricted cash on the balance sheet tied to the facility. So the debt looks higher than it is at this point. It's pretty close to being paid off.
And I remember at one point people were saying that this was trading at an implied cap rate of like 15 or 16%, you know, whereas they're selling some of these properties, you know, closer to 6% or 8%. Is that still the dynamic? I mean, is it still that mispriced? Is it, you know, have you looked at it kind of on a cap rate basis on a total blended basis?
Yeah, and I think that the cap rate basis isn't particularly helpful with this vehicle just because of the nuance from property to property. Mm-hmm. They just sold a CVS campus in Arizona at a 6 cap with a 15-year lease, had data center, optionality, redevelopment, all sorts of good stuff. But they also have stuff in here that's terrible. But they just sold a building in the UK for about $4 million, which had about $4 million of remaining rent this year. And then the lease is going to expire. So they basically sold it at 100% cap rate. So fortunately, that one was not key to the value thesis here. But anything that has both 6 and 100% cap rate properties in the portfolio is certainly tough to value in aggregate. So I think, yes, broadly speaking, you're trading around a 15 on what's left in this portfolio. But the asset level valuations were kind of where the money was made here in terms of understanding which properties had value, which ones didn't, and that some of the bad ones were only going to hurt you so much.
That makes sense. And then do you have a sense for, you know, what your liquidation value is? I mean, I think I looked at it and I think I haven't taken a refresh look at it, but I had like high 30s to low or to mid 40s in terms of potential liquidation, you know, equity value, depending on how long that takes. Do you have a sense of what the liquidation value is?
Yeah, I think we're going to land somewhere in the 45 to 50 range. On some of these properties, I think there was a pretty wide range of outcomes, and as they keep selling them down, that range has been narrowing. The cone of uncertainty, as it were, is narrowing. So I think the main thing I think anyone that's following this thing is still waiting on is figuring out what they're going to do with their KBI or tower in Houston. This is a very, very valuable lease with KBR. They've got about 6 years left on it. It's over $20 million a year right now with another increase before the lease expires. Um, that's by far the largest piece of value left in this entity. So you've got about a $500 million enterprise value right now, and probably somewhere around a third of that is in this KBR lease. So I think everyone's just waiting to see how that crystallizes. That's one where the Houston market is relatively challenged. So I'm happy that they didn't try to move too quickly to sell a building with a very high cash generating lease. But that's the sort of stuff that, that can move the valuation a bit. But beyond that, there's not a whole lot in this thing that's going to move my liquidation estimate more than a dollar or so a share, one way or the other. And I think a testament to that has been that as I've done more research and got more comparable sales in different markets and talked to different guys with knowledge of the space, my values keep changing, but the general target price has stayed right around $45 over most of the last 6 months, year time frame. I think there's a couple in here in particular in the LA market that you see some comps for them that really scream, wow, this is going to surprise people to the upside. Their Google property just renewed another 5 years. But you wouldn't know it reading their financials. It's buried in a footnote on the end of their supplemental disclosure that they just don't advertise this stuff very much. But that Google property is in an area where office properties are listed for around $1,000 a square foot. Net lease is trading in an aggregate of about $100, $110 a square foot for what they've got left in the portfolio. So, that one sale with a property like that covers a multitude of other bad ones, and it's not the only good thing left in here.
And then it's obviously hard to get a sense for when the liquidation is going to play out. Like you said, you don't want to do this in a fire sale manner. The Houston market is maybe a little weak. But I guess what's your best sense in terms of when the majority of the value, will be realized? I mean, these things can have very long tails, right? It can play out in 3, 4, or 5 years, but if you get 90, 95% of the value back within a year or two, obviously that makes for a really attractive IRR. So, how are you thinking about in terms of timing and the investment kind of on an IRR basis?
Yeah, no, I think that's exactly right. My guess is going to be that someone that's bought this thing at $30 a share will have gotten that much back in dividends within the next 2 years. I think that broadly speaking, you can get there based on the good leases they have left in the portfolio. I think what got me more comfortable with this one versus some other, sad liquidation outcomes like Seritage and the mess that's been, is basically the longer you sit here and wait, the more the business is going to cash flow. You don't have a gun to your head in the sense that all these office buildings are sitting vacant and you're paying a bunch of SG&A and you're paying a ton of interest on the debt. Because they've gotten that debt down so quickly, because there's so little cost burden here, basically you're just sitting here and the properties are cash flowing. And, in the event that, they don't sell anything for the next year, you're going to cash flow over $50 million. That's more than a 10% yield on what you currently own. You've got 5-year average lease left in this portfolio. There's really no rush per se to get some of these things out the door. So I think it's going to go pretty quick. I think that's going to get you somewhere to that 45, 50 range. You're going to get your cash back. But as things take longer, it's not really a bad outcome for investors here because of the relatively high cap rate all these things are trading at. But converting that to cash is pretty advantageous too.
Yeah, that's a great point, right? All that interest debt is paid off. So it's like, yeah, if you have to wait a little bit longer, at least you're getting paid. You're getting paid to wait, and then maybe they initiate a dividend, and other investors who wouldn't be interested in it come in to take a look. Super interesting. Okay. Let's move on to another real estate name. So I know you've done work on this. I don't know where you've come out, but a recent spinoff is Site Center, which recently spun
Yep.
off a company called Curbline Properties. Site Center, that's the remain co. It is focused really on open air shopping centers in suburban, well off areas. It spun off its business called Curbline Properties, which trades under the ticker CURB. This is a convenience store story. So, Curbline will tell you that they are the first and the largest big mover in this commercial, publicly traded space, or in the convenience store asset. So they're buying, smaller assets that have higher rent per square foot and have lower capex requirements if you move out a tenant. Uh, Typically with spinoffs, as you know, there's usually a bad co and a good co. Usually the spinoff is the bad co, but in this case, the spinoff was the good co, the convenience store assets, Curbline Properties, and then the remain co is considered the quote unquote bad co. So I don't know, have you spent any time looking at that one? And is one side of the transaction more interesting than the other?
Yeah. So I think this is one where I got it wrong. I spent most of my time trying to get a really good valuation on the Site Center RemainCo, kind of hoping this would be another NLOP type situation where, this curve line, the good profit one comes out, it's valued really richly, and everyone dumps the RemainCo, and you get a good price. And that's not really what happened. People did dump the RemainCo. It's sold off since the transaction, but frankly, it's been deserved, especially after their most recent quarterly update. Whereas Curbline, I think, especially they pushed some sales through right before the spin happened. They were able to put extra cash into the war chest that was going with Curbline, so they got another $200 million than what they were initially expecting, and all of that is going to go get deployed at they're saying around 7% cap rates for an entity that's trading closer to a 5. So there's a lot of accretion to go there just from the deals they're going to go do. There's a lot of excitement around the low capex nature, like you're saying. I've been reading that these properties are more in the 7 to 10% of NOI capex range versus like traditional retail being closer to 25. Because they have shorter leases, you can market the market sooner, you can get better rent growth. Like this thing's probably going to grow 10% a year and convert that at a higher rate than your traditional REIT. And because there's low institutional ownership of more of these convenience assets in the space, they've got a ton of white space to go expand into. So very interesting growth story there. I think for me personally, trying to make long-term bets on some spaces like this again is not really where I see my best strength. So I could see this thing really working well. For those who hang out on Value Investors Club, I thought there was a pretty good summary of the trade there from one user that came out. I'm not sure if it's on the free 45-day window yet, but it's a great overview. I think it sounds like a story that's probably going to work out pretty well. It's going to be very sensitive to rates, like you're saying, given the low cap rate here. If you have a long-term view of higher for longer interest rates, maybe this isn't going to be quite as exciting. But rate cuts plus growth, there could be a lot of fireworks over at Curbline. Site Centers is basically just these remaining legacy retail grocery anchored assets. The thesis here, at least if you want to get excited about upside, is hey, they sold a couple $1 billion worth of assets in the last couple of years, which by all accounts a very tough retail and general real estate commercial market. And they've done so at relatively attractive cap rates. So the idea for getting long is basically, hey, these retail centers are probably continue to get assets, rates to come down some. You're going to get a chance to sell these at good cap rates. You're probably going to see this entity liquidated in the next couple of years and realize a decent return. The NOI that they came out with was a little bit under $100 million, which is where more people were expecting it to land at or above there, given kind of connecting the dots on the sales. So the NOI is disappointed there a little bit, which also implies the sales that they did in Q3 were not as good of a cap rate as you would think. So the problem you have is now the numbers have moved against you. They've already gone out and redeemed their preferred stock that was outstanding, which I thought one of the ways I thought you could win here was if they merged the entity with another public company that was outstanding and left the press trading for, hey, we're selling the rest of these to Kimco. They're going to, continue to service as preferred, and you can probably get a bit of a haircut on them relative to redeeming them for face value. But they didn't do that. It seems like management was focused on trying to get those redeemed and give themselves the best shot at getting cheap funding for Curbline down the road. So I guess from what I've seen here, I was hoping, hey, this spins out, maybe it's worth $20, $22 a share. But if you're looking at the cap rate they sold stuff at, if you're looking at what's outstanding, this is probably somewhere, it's still, you probably can still get $20 a share liquidation value here, but you're going to need to see some of these rents get, released higher. You're going to need to see cap rates come down a bit. And based on what they've done so far, that's not really where things are at. So this is, probably pretty fairly priced around $16 a share.
Yeah, I had kind of the same approach. I was thinking we were going to have like an NLOP situation where the RemainCo was just going to get puked. And then the interesting thing too here is that there's just the one amazing thing about Site Center RemainCo is that the asset sales were just happening so fast. So the quantum of sales were just pretty extraordinary. And I think it could have been a really interesting setup if they didn't give, I think they gave the spinoff a bunch more cash than they had initially thought. So if you had kept the cash on the balance sheet, the NAV for that RemainCo would have been a lot higher. But I'm with you too. It seems like in Q3, based on how much NOI guidance was reduced and this gross proceeds from sales, it seems like the cap rate that the assets were sold at was like 7.75%. And so 7.75. And that is higher than the cap rate of historical sales. So it seems to be moving in the wrong direction a little bit. And so there's definitely upside. There's very little debt. The preferred's going to get paid out. So I think there's very little risk. But yeah, I was a little disappointed that we didn't get more of an opportunity. And then with Curbline, I agree as well. It seems like a great story, a great growth story, but it's I'm looking for like the blood in the water situation as opposed to like the high quality company that's not quite as recognized as it should be, for better or worse. So it'll be interesting to see that one play out. So the other name that I wanted to chat with you about was Magnera Corporation. So MAGN, and this is a live situation that is actually pretty interesting. So just as background for folks listening, so Berry Global basically spun out its health hygiene non-woven business and merged it with Glatfelter. And then they did a reverse split. And then the new business is called Magnera Corporation. And the 90% of the equity of this new business was distributed to Berry shareholders. So it's kind of like a classic situation, classic indiscriminate selling situation where, I don't know what Berry's market cap is, maybe $5 billion, are getting shares of this company that when it was trading under Glatfelter, because you could see the implied market cap was like sub 1 billion. Glatfelter, I think, had like a 150 million market cap. So essentially you're getting spun off this micro cap. And so it's a really interesting situation that I'm still doing some work on, but I'm curious if you've spent any time on this one and what your thoughts are.
Yeah. No, this one, I think it's super interesting as well. Kind of more like the net lease situation. Barry basically said, hey, we're going to pay ourselves a cash dividend out of this thing. We're going to lever it up to about 4 times debt to EBITDA, and we're going to spin this off to our shareholders, and the shareholders mostly want this out of our business. So this is their lower margin business. This was not really their growth vertical. So as far as their shareholders are concerned, this is kind of like NLOP dumping their offices to WP Carey. The reason for doing it was to get it out of the portfolio, not because this is a growth vehicle or somewhere they want to invest. So I like that dynamic in the sense that it does create more indiscriminate selling. And there's been some of that. I mean, it's spun out, I think, in the high or low $20 a share range, and it's traded as low as around 18. So there's been some selling pressure. It hasn't dumped quite as badly as the net lease SpinCo did. But certainly taking a dive. They put out a spin deck back in February, which basically said, hey, if this trades on comp, this should be a $1.8 billion market cap. And as of today, I think we're around 700 million. So what they were saying they were going to get for this versus where it's actually trading is a pretty large gap. So you can quibble with their comps a little bit, and if Barry is trading around 8 or 9 times EBITDA going forward and is higher margin, does this deserve to trade at 8? Maybe not. But should it trade at 5? Maybe not that either. So I think that it's really interesting in that regard. I think to get comfortable here, you're going to need to figure out how much you believe they can do in the synergy bucket they put out. I think there's about $75 million of synergies and cost efficiencies that they're projecting they'll get out of this merger over like a 3-year period. So, is this really a 400 million EBITDA business? Is this a 475 million? How trial earnings are we looking at? I think these are all questions that I think you have to answer if you want to get interested. But I do think this is a setup that investors can get pretty intrigued by.
Yeah, I think so. One thing that has worked well for me in the past is situations where you have fundamentals inflecting positively, where you have the spinoff dynamic, and then because a lot of times you'll have a spinoff, but it'll be a really crappy asset, where a really crappy industry. And it's like, yeah, you can puff a few more puffs of the cigar and you can run your discounted cash flow and like the stock is undervalued. But the really interesting situations are the ones where the fundamentals are inflecting higher. Like a good example of this was Anglo American spun out Thungela Resources like in 2021. This was a coal company. Like nobody wanted to own coal. Obviously, no investors wanted to own coal, dirty fossil fuel. And then, like all the other commodities, coal went crazy. And so, you had the indiscriminate selling pressure coupled with the really fundamental rise in coal prices and, some crazy, free cash flow growth. And then, I don't know if we're seeing that in this setup, but I went back and I looked at the health, hygiene, non-woven business, like on a quarterly basis, based on revenue and based on operating earnings. And it seemed like Q4 was the trough of that business, both from a revenue and from an operating profit perspective. And then for Glatfelter too, it was kind of a similar dynamic. So like, I don't know if it's going to rip back. It does seem like we're coming out of the bottom of a cycle. And so I agree. The fact that we have pretty low valuation, coupled with pretty low fundamentals, right? Kind of trough earnings on trough multiple, like that could be a pretty interesting setup. Do you have any sense of how much free cash flow this business could generate?
Yeah, great question. So if we ignore synergies and just say, hey, it's probably a $400 million business, EBITDA, I think the way that they've guided is that CapEx requirements will kind of be in the 2 to 3% of revenue in the nearer term and moving towards 4 to 5 longer term. So something in the neighborhood of $100 million a year for the next few years, moving towards 150 million. You're going to have around 100 million of interest expense on the debt that they're now sitting on post-spin. So that there is going to eat up around half of EBITDA, but that leaves a lot of room for cash generation. So I think you can get to, pretty comfortably somewhere in the 100 to 150 million of free cash flow range on this thing, which, with over, almost $2 billion of debt, obviously it's like, oh, that's, they're conservative, but they're not going to be paying that down super fast. But, as EBITDA improves, as they do a little bit of pay down, it's not unreasonable. It seems like this is, maybe if we really do think the business is inflecting in Q4, which, as you said, it looks to be growing again. Glatfelter raised their guidance most recent quarter. There were some good and encouraging signs that things are coming back. Then, $150 million of free cash flow generation on a 700 million market cap is a pretty interesting leverage situation. And if that can continue to grow and prove that the bottom is in, then 700 million is probably about the right number for that business, as capital intensive as it is.
Yeah, the other thing that I was looking at just from a valuation perspective is it's like, so they have some comps and the management team, put out, hey, this transaction, if you value it at 8 times EBITDA, we're creating 1.8 billion of equity value. And then I think you tweeted something like, here's what management said. And then the reaction was the stock market was down, this Barry stock price was down like 10%. So clearly the market didn't really buy it. But like one thing that I'm thinking of, I'm trying to get comfortable with the valuation. And one thing was just Glatfelter's historical EV to EBITDA LTM basis. Historically, they've traded, I think the lowest they traded was like 5.5 or 6 times. And the highest they traded was, 10 times or higher. And so you have kind of that trough valuation. The new business is basically double that. It's going to have higher margins. So theoretically, you should have a higher valuation than what Glatfelter traded on. So I agree. I think it looks like a super interesting situation. The other thing that's interesting is that the reverse split, like for some reason, I've just noticed this phenomenon where when stocks have reverse splits, I don't know if it's the algorithms or whatnot, or it's people see a higher price stock in their brokerage account and they're like, oh, I'm automatically going to sell this. But typically, it seems like there's some selling pressure after these reverse split situations take place. Like I saw it with the Syria and the Liberty merger. They did a reverse split, and there was some pretty heavy selling pressure. So yeah, no, this is an interesting one for sure.
Something like this too. I do like the fact that there is still an aligned team that's going out here to create value. Just, compared to something like the site center transaction where it feels like, hey, we're putting all of our chips in the Curbline basket, and this is just kind of a liquidating entity. You do actually have people, actresses that look to drive value and do something long term. They are going to want to run this. It's not just a liquidating entity. I think they put a team in place that can go and execute here. So I think that's the kind of opportunities that at least in the spinoff world, you can see these guys that hey, maybe we've been underinvested in our parent company. Hey, maybe Glatfelter didn't really have a chance to do things the way they would want to because they were so constrained by their debt. Hey, now we're going to capitalize them a little better instead of lose. So I do think that situations like that, you can sometimes see a management team that, hey, we were the underperforming, stepchild of this company, and now we're getting a chance to actually shine at what we're good at, and not just what the parent company wanted us to do. Getting a chance to do your own thing. So I'm hopeful that that's kind of the setup you're going to see here versus just some sort of, hey, we're dumping this business and trying to liquidate it for parts.
I do. I need to look up some academic research on this or do my own research. But it seems to me, just from an observation perspective, that I like to see a management team of a spinoff come from the parent company, because I just feel like they know where the inefficiencies are. They know where the areas where they could have invested, where they were just shut down by their boss. And so, theoretically, there could be a good situation here where the Barry management team that used to run the health and hygiene nonwoven business is going to be able to have their own publicly traded company. Theoretically, they should be able to integrate this. Historically, they've done a decent amount of acquisitions, and so it does seem like it could be a very interesting setup. Well, thank you so much, David, for taking some time today. Are there any other spinoffs on your watch list or anything you want to chat about before we wrap up here?
Nothing else right now. I think these are you hit on the three big ones I've spent the most time on here in the last year. So this was fun, and I think it's a really fun area to be hunting in, and I think especially there's still some opportunity in these names. I don't think like all of these have played out. So glad we got to spend some time on them, and look forward to the next time.
Yeah, for sure. Well, David, thank you so much for spending some time with me. And if investors want to follow you, I know I follow you on Twitter. You share a ton of actionable insight, real-time analysis. But if they want to learn more about Kingdom Capital or follow you or get in touch with you, what's the best way to do that?
Sure. So yeah, I'm active on Twitter. Our website, kingdomcapitaladvisors.com, has all of our fund letters and contact info if you want to reach out. I'm always happy to chat stocks, and we're around. So happy to hear why I'm wrong about any of these names. I'm sure there's always going to be a few. And if you've got anything else that in the spinoff world or otherwise thinks interesting, I'm always all ears.